It never begins with panic. It begins with structure. Quiet agreements, quiet meetings, quiet hands shaping rules no one voted on. A decision made in Switzerland shifts interest rates in Brazil. A conversation in Washington moves billions through London before sunrise. And the networks behind it all, most people never see them until the moment they fail. But once you trace the lines, from Bretton Woods to Basel, from shadow banks to digital markets, you begin to understand something unsettling. Global finance wasn't built to be visible. It was built to be powerful. Picture this. It's March 2008. Inside a gleaming Manhattan tower, traders at Bear Stearns are staring at their screens in disbelief. 85 years of Wall Street history is about to vanish in 72 hours. But here's what they didn't know. The forces destroying their firm that morning weren't born on trading floors or in boardrooms. They were architected decades earlier in quiet Swiss meetings, designed by officials and economists whose names rarely appear in headlines. Welcome to Empire Economics, where history and money collide. And today, we're pulling back the curtain on the most powerful financial networks ever created. Networks so influential they can influence governments, reshape entire economies, and help determine which nations thrive and which ones struggle. Yet their names rarely appear in headlines. Their meetings happen behind closed doors, and their decisions ripple through every mortgage payment, every pension fund, and every currency exchange on Earth. The story begins not with bankers, but with diplomats. July 1944. The Mount Washington Hotel in Bretton Woods, New Hampshire. Outside, World War II is still raging. Inside, delegates from 44 nations are quietly redesigning the entire global financial system. They're not just negotiating treaties, they're designing the framework that will shape the global monetary system for the next century. The man leading this transformation is John Maynard Keynes, the brilliant British economist whose ideas will reshape capitalism. Across from him sits Harry Dexter White, representing the emerging American empire. These two men, locked in elegant debate over coffee and cigars, are about to birth institutions that will wield more power than most governments: the International Monetary Fund, the World Bank, and most crucially, a system that places the American dollar at the center of global trade. But what they're really creating is something far more profound. They're building the first truly global financial nervous system, a network where decisions made in Washington can instantly affect rice prices in Bangladesh, where a meeting in Basel, Switzerland, can determine whether millions of people in Argentina keep their jobs, where a handful of central bankers can coordinate policies that touch every human being on the planet. The genius of Bretton Woods wasn't just economic, it was architectural. By anchoring every currency to the dollar and the dollar to gold at $35 per ounce, they created what economists call the ultimate network effect. Every nation that wanted to trade internationally had to hold dollars. Every bank that wanted to finance global commerce had to work within American rules. Every government that wanted stability aligned with US-centered financial structures. Fast forward to 1971. President Richard Nixon stands before television cameras and announces that America will no longer convert dollars to gold. With those words, he destroys the Bretton Woods system. But he doesn't destroy the network. Instead, he sets it free. The dollar, untethered from gold, becomes something unprecedented in human history. A global currency backed not by metal, but by trust in American financial and institutional strength. What happens next reveals the true nature of these hidden networks. Without gold as an anchor, the system should have collapsed. Instead, it evolved. Central banks around the world, rather than abandoning the dollar, doubled down on it. They bought American bonds. They held dollars in their reserves. They made the dollar more essential to global trade than it had ever been before. But here's where the story takes a darker turn. power concentrated in networks tends to create unintended consequences. By the 1980s, a new breed of financial institution was emerging: investment banks that weren't really banks, hedge funds that could move billions in minutes, insurance companies that took on complex risks that proved difficult to assess. Economists would later call this the shadow banking system, a parallel financial universe operating through non-traditional regulatory channels. The shadow banks weren't trying to overthrow the system, they were trying to profit from it. They discovered that the same networks that connected central banks could be used to move money faster and in larger quantities than ever before. They found ways to bundle mortgages from Kansas farmers and sell them to pension funds in Tokyo. They created derivatives so complex that even their creators didn't fully understand the risks. Meanwhile, in Basel, Switzerland, something remarkable was happening. The Bank for International Settlements, founded in 1930 and owned by 63 central banks, had become the unofficial headquarters of global finance. Every 2 months, the world's most powerful central bankers would gather in a curved tower overlooking the Rhine River. No cameras, no transcripts, just quiet conversations that would determine the fate of currencies, interest rates, and entire economies. These Basel meetings weren't conspiracies. They were coordination mechanisms. When financial crisis struck one nation, these networks could respond instantly. When inflation threatened global stability, they could act in unison. When banks grew too large to fail, they could craft rescue plans that transcended national borders. But coordination, it turned out, had a price. The more connected the global financial system became, the more vulnerable it became to systemic shocks. A housing bubble in Florida could put stress on credit markets in London. A currency crisis in Thailand could destabilize economies across Asia. The failure of a major institution could create widespread disruption across continents. The networks that were designed to create stability had inadvertently created fragility. The same connections that allowed prosperity to spread globally also allowed panic to spread at the speed of light. By 2008, the world's financial institutions had become so interconnected that allowing any major player to fail risked bringing down large portions of the system. That March morning, when Bear Stearns traders watched their screens in horror, they were witnessing the logical conclusion of 70 years of network building. The firm that employed them wasn't just a Wall Street investment bank. It was a critical node in a global web of financial relationships so complex that its failure could trigger cascading stresses worldwide. Within 72 hours, Bear Stearns would be sold to JP Morgan Chase. The Federal Reserve would lend $30 billion to make the deal happen, and the precedent would be set. Some institutions had become so interconnected that abrupt failure risked widespread disruption. What emerged from the ashes of 2008 wasn't a simpler system. It was a more concentrated one. The largest banks didn't shrink. They grew larger. The shadow banking system didn't disappear. It evolved new forms. The networks that connected global finance didn't weaken. They strengthened, becoming more essential than ever to the functioning of the modern economy. Today, these hidden networks operate with unprecedented power and sophistication. But their story is far from over. In our next segment, we'll explore how these same networks are adapting to digital currencies, artificial intelligence, and geopolitical tensions that threaten to reshape the entire global financial order once again. The men who built these systems in 1944 could never have imagined the world they were creating, but their architectural genius lives on, invisible but omnipresent, in every transaction that flows through the arteries of global commerce. The transformation didn't stop with bailouts and mergers, it accelerated. Within months of Bear Stearns disappearing, the hidden networks that governed global finance began their most ambitious expansion in history. But this time, they weren't just responding to crisis. They were fundamentally reshaping how modern monetary policy operated. September 2008. Lehman Brothers collapses on a Monday morning. By Thursday, the commercial paper market, where corporations borrow money for basic operations like payroll and inventory, has essentially frozen companies that have operated for decades suddenly can't access cash to pay their employees. The networks that connect every corner of global commerce are seizing up like a massive engine running out of oil. But here's what most people missed. While headlines screamed about bank failures and stock market crashes, a quieter revolution was unfolding in the basement conference rooms of central banks' worldwide emergency phone calls. Between Basel, Washington, London, Frankfurt, and Tokyo weren't just coordinating rescue packages. They were laying the groundwork for something unprecedented: the birth of truly synchronized global monetary policy. The Federal Reserve cuts interest rates to near zero within hours. The Bank of England follows. The European Central Bank joins the next day. The Bank of Japan makes similar moves. For the first time in history, the world's major central banks are moving in perfect coordination, their decisions flowing through communication networks built over decades of quiet cooperation. But cutting rates wasn't enough. The networks needed liquidity, and traditional banking channels were blocked. So central banks did something that would have been unthinkable just months earlier. They began creating money directly and injecting it into the financial system through a process called quantitative easing. The Federal Reserve bought government bonds and corporate debt. The European Central Bank purchased bank bonds and covered bonds. The Bank of Japan expanded its balance sheet to unprecedented levels. What they were really doing was performing emergency support on the global financial circulatory system. When traditional arteries became obstructed, they created new pathways for money to flow. When banks stopped lending to each other, central banks became the lenders. When markets stopped functioning, central banks became the buyers of last resort. The scale was breathtaking. Between 2008 and 2015, the world's major central banks created trillions of dollars worth of new money. They expanded their balance sheets by amounts that dwarfed the GDP of entire nations. They bought bonds, mortgages, corporate debt, and even stocks in quantities that fundamentally altered how these markets operated. But the most profound change wasn't in the numbers. It was in the architecture itself. The crisis had revealed that the global financial system wasn't just interconnected, it was interdependent. A bank in New York couldn't function without funding from London. A pension fund in Germany couldn't operate without bonds issued in Washington. An insurance company in Tokyo couldn't manage risk without derivatives created in Chicago. This interdependence created both vulnerability and influence vulnerability, because problems anywhere could spread everywhere. But influence because the institutions at the center of these networks, particularly central banks, could shape economic conditions across the entire planet with unprecedented precision. The Bank for International Settlements recognized this shift immediately. Their monthly meetings in Basel transformed from coordination sessions into operational command centers. They established new committees to monitor systemic risk. They created frameworks for sharing information about emerging threats. They developed protocols for synchronized responses to future crises. Today, these networks operate with a sophistication that would astound their creators. Digital algorithms execute trades in microseconds across continents. Central bank communication travels through encrypted channels that connect every major financial capital. Shadow banking assets now exceed $200 trillion, dwarfing the traditional banking system they were designed to complement. Yet for all their technological evolution, these networks still operate on the same fundamental principle established in that New Hampshire hotel in 1944. Coordination creates stability, but it also concentrates influence. The institutions that sit at the center of these networks don't just participate in the global economy, they help shape it. They don't just respond to crises, they help determine how global markets interpret systemic risk. Understanding these networks doesn't require conspiracy theories or finger-pointing. It requires recognizing that modern finance operates through relationships built over decades, protocols established through quiet cooperation, and trust developed through repeated coordination. The next time you hear about a currency crisis, a banking merger, or a coordinated central bank response, you'll recognize the architecture at work. The hidden networks that built global finance aren't going anywhere. They're adapting, evolving, and expanding their reach into digital currencies, artificial intelligence, and new forms of economic coordination that haven't been invented yet, but their fundamental purpose remains unchanged. They exist to ensure that money flows, that markets function, and that the complex web of modern commerce continues to operate. History shows us that understanding these networks is the first step toward understanding how the modern world actually works. Not the world we imagine exists, but the world that operates behind the scenes, through quiet meetings and careful coordination, shaping the economic reality that touches every human life on Earth. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If you enjoy learning how history and money intertwine, subscribe to Empire Economics for more untold stories.